So it's true. I sold all of my shares of QYLD, the Global X NASDAQ 100 covered call ETF. And I did so at a loss. This probably leads to many questions considering the videos I've made about QYLD in the past, such as, why did you sell QYLD? Why did you sell now? What are you investing in instead? What do you think about QYLD now, and should I sell? Let's address all of these questions right now. First off, let's be very specific about the facts. I owned 310.04 shares of QYLD and 231.693 shares of RYLD. I sold both positions, and I will lump them together for the sake of this video since they are nearly the same investment. The position for QYLD was worth approximately $5,052 with a cost basis of $6,099, which was a loss of 17%. The position for RYLD was worth approximately $4,472 with a cost basis of $5,248, which was a loss of 14%. These two investments made up approximately 5.87% of my entire portfolio. Now, it's also important to talk about my specific situation and my investment objectives. I have a long-term investment outlook. I'm 35 years old, which many people say is pretty young, though the damage inflicted by my boys tells me I am much older than I think. I do have our upcoming 2024 year-long family trip around the United States, and we may need to tap into some dividend income, option income, or potentially even some of the assets in the portfolio to make that trip memorable for our family. Apart from this trip though, the purpose of this portfolio is to give us the freedom to retire before traditional retirement age, meaning a 15 to 20 year time horizon. So those are the facts. Why did I sell QYLD? Well, perhaps the better question is, why did I own QYLD in the first place? For a long time now, I have been pretty clear on my assessment of QYLD given its ultra high dividend yield and capital depreciation over time. That assessment has been QYLD, and for that matter, XYLD and RYLD are great fits for your portfolio if you need cash flow right now, and you are not prioritizing capital appreciation over time. Neither of these situations accurately describe me. So why did I buy QYLD in the first place? I'll admit part of it was because I felt like I needed to have some skin in the game because of how much I was talking about QYLD. Additionally, I felt at the time it was a reasonable holding in the high yield portion of my dividend portfolio. My initial strategy was to have two separate dividend portfolios. One of the portfolios, about 60% of the net assets in the portfolio, was to be for dividend stocks with a history of raising their dividend many years with strong dividend growth rates. And then the other portfolio, about 40% of the net assets, would be consisting of high-yield dividend investments. I now focus the majority of my assets on dividend stocks and ETFs that are quality dividend stocks with a strong history of raising their dividend every year, but that also have the ability to generate option income through selling covered calls. When it comes to option premium, not all investments are created equal. Some investments have high dividend yields but really no option premium, whereas there are other dividend stocks that have both dividend income and are also very rich in option premium. Investments such as QYLD and even ARCC, JEPI, and ABR have nearly zero implied volatility, and as a result, there's really no option premium available. Essentially, QYLD never really was a great fit for the portfolio, but now, more than ever, it was not aligned with my investment goals and objectives. So why did I sell now? Well, that's an excellent question. We are experiencing very tough times right now, and most investments have lost significant value. Most people have heard that selling investments when markets drop is a terrible idea. And that's true. At least that's true if you are reacting emotionally and pulling money out of the stock market. In my case though, I made a strategic decision to invest in something different, not pull my money out of the markets completely. Yes, I am locking in losses by selling these investments right now, but I'm also taking advantage of different investment opportunities at really low prices. Prior to making some changes to the portfolio, I had approximately $69,000 invested in the high yield dividend portfolio and about $92,700 in the core dividend portfolio. In addition to liquidating the QYLD and RYLD positions, I also sold other positions such as DKL, STOR, and ABR. I opened up approximately $39,000 in the portfolio with the intention of creating a new position in SPY, the S&P 500 Index ETF. Once I have this ETF in my portfolio, I will start selling covered calls to generate option premium. Now, I'm still a dividend cash flow investor, make no mistake, but I do like having 1 to 2 different index ETFs in the portfolio as well, especially since we are at market lows, to capture growth in the overall market when prices reverse, and these index ETFs have significant option premium and also significant volume and liquidity with multiple expiration dates every single week. So I ended up selling QYLD, but does that make QYLD a terrible investment for you? Should you sell? This is a question unique to every investor and comes down to your investment goals and objectives. Additionally, your investment decisions should not be based on what I say here in these videos. I hope they provoke you to think about what you are trying to accomplish and give you ideas for ways you can invest, but ultimately, please make sure you do your own research in addition to what you hear on YouTube, as this is not investment advice. That being said, I do feel very strongly that QYLD is not a great fit for investors who have a long time to grow their portfolio. Over time, QYLD, I think, will continue to make lower highs and lower lows. When will it happen? Hard to say, but I just cannot endorse it as a quality investment for younger investors, especially since QYLD does not have a track record of raising their dividend every year. On the flip side, if you need cash flow right now because you are retiring or are already retired, QYLD might make a lot of sense for you. You can even think of QYLD as an annuity alternative. With normal annuities, you give an insurance company a lump sum of money now, and they in turn guarantee a specific amount of monthly cash flow for a specific amount of time, up to and including the rest of your life. You don't see that lump sum of money ever again though. With QYLD, you can expect a large part of your principal balance to still be there and receive monthly income into the future. It ultimately comes down to your specific situation. It's time for the Average Joe live Q&A number 5, and this segment of the video is sponsored by Moomoo. Moomoo is an active, top-of-the-line stock trading platform ideal for active stock traders. You get access to level 2 bid-ask trading data, access to breaking news about stocks in your own portfolio, as well as stocks that are only in your watch list. You also have the ability to practice unique strategies risk-free with a paper trading account. Right now, as an exclusive offer to the Average Joe investor audience, you have the opportunity to collect up to 15, you heard me right, 15 free stocks valued at up to $2,000 each. Simply open an account and get 1 free stock. Deposit $100 and get 5 free stocks. Deposit $500 and get 15 free stocks. I personally use Moomoo myself, and it is a great platform to use. If you're interested, check out the link in the description below and pinned in the comments. All right, let's get to our live Q&A based on the voicemail I received from Cody.
Hey, Average Joe. My name is Cody. When I first started investing, I was day trading. And as I learned the risk that comes along with that, even though I was treading water and I was keeping my head above water, even I decided to go along with dividend investing. And as I come across your videos with these options trading to put a catalyst on a portfolio for cash flow, I'm having trouble distinguishing the speculativeness that comes along with day trading and what I perceive options trading to come along with as well. What is your opinion in terms of seeing options trading as a speculative way to invest? Would you agree with that options trading is a speculative way of investing?
Thank you so much, Cody, for leaving this voicemail, and it's a great question, and we're definitely going to tackle it. Let's start with day trading. Now, are there people that can actually day trade and are profitable? Absolutely. Do I think it's a great idea, though, to be a day trader? I don't think so, and I think that most average Joes out there would fail at this. Now, to be very clear and transparent, options can absolutely be used to speculate, and many people speculate with options by buying options for stocks that they think are going to go way up in the future. This is not the type of option trading that I advocate for. For me specifically, and what I talk about on the channel, I almost exclusively talk about using options within the framework of selling covered calls on dividend stocks I already own. Now, this is only speculative in nature to the extent that I don't know what the future holds, right? None of us know what's going to happen in the future. Stocks could go up or down. But with respect to selling covered calls, the amount of risk that I'm taking is very limited and the odds are in my favor. For example, if I have a dividend stock that has a price of $100 per share and my cost basis is below that, let's say it's $90 per share, and I want to sell a covered call with a strike price of $105 per share. The worst case scenario caused by selling the option is that it caps how much growth I have in the portfolio if the stock were to zoom past $105 per share. If the stock drops in value, there's no negative impact as a result of having the covered call. It actually mitigates some of the downside risk because I'm receiving option premium in exchange for selling the call. As long as you are selling covered calls at a strike price that is above your cost basis in the investment, there is no downside risk. There's no risk of loss of your capital as a result of selling the covered call. Can you get much more aggressive and can you really speculate with options? Absolutely, but that's not what I talk about here on the channel. How we utilize options in our portfolio is going to dictate whether or not it is speculative in nature. I really appreciate the question, Cody. For everybody else out there, if you guys have questions or concerns related to dividend investing, options, anything in between that you think other average Joes out there would benefit from hearing answered, please make sure to check out the link in the description below for SpeakPipe. Leave me a voicemail. I can almost guarantee at this point your question will be featured live on a video and I will answer that question. Make sure to leave your 2 cents down in the comments below. I appreciate your feedback. Thanks for watching and please continue to stay healthy, both physically and financially. Have a good one.